All right, good evening, everybody. And thank you for joining this training today. We'll be starting shortly, just in a few minutes. Just trying to give maybe some late joiner 1 or 2 minutes. We will start. I think we should be starting in the next 2 minutes. Thank you, everybody, for joining the meeting. And we are very excited to have all of you. I think we have a considerable number of people already on the call. We have about 66 people already. I'm sure we're still going to get some other late joiners who will be joining us in the course of this training. Are we here or here? I know we are muted, so we might not be able to respond, but can we do this? Can we all go to our chat box and just say, are we all here? If you are here, please just type yes, so that I can be sure that you are here. Please chat, yes, 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 yes. Oh, excellent, excellent, excellent. All right, all right, all right. So, on behalf of our team, I welcome all of us to this 2025 IFRS refresher course and question and answer section. Starting 2025 IFRS strong. Just some form of background to this training. So this training we actually used to hold it as a closed program in-house for PML Professional Services personnel. So it used to be strictly our in-house annual IFRS refresher course. But this year, we decided to open it more to the public because we believe other people can also benefit. And that's how we open it up. And the responses we got was fantastic in terms of even number of people that are registered to attend. It was very, very encouraging. So we hope that we'll be able to keep it up. It's a refresher course, and I will tell us that when we run this full course at full length, if we want to run what we call IFRS immersion course, we take 5 days. 5 days of average about 6 hours. So if you do 6 times 5, that's about 30 hours. But the same or similar curriculum, we want to run it in 8 hours. So we'll just go through some of the salient key issues in each of those standards. And interestingly, we've also decided to spread it over 4 weekends. We know that some of us might not even be able to take time out of your regular work schedule, but if you really think that you want to know accounting standard, IFRS, you may be willing to take 2 hours out of your Saturday evening to attend to this, so it doesn't disturb your regular work. It's a personal thing and it's a personal development. So for the rest of February, we will do 1st of February, 8th, 15th, and 22nd. We'll hold that section looking at IFRS. And I will be the lead facilitator for the whole sections, and I will be joined by my other colleague, Babatunde Abimbola. So we will be responsible for this event. Today, we also have Moturaya providing some coordinating support to us. So I welcome all of us. And just also for our information, after each of these sections, we will answer whatever questions we have in the chat box. Because of the number of personnel, individuals we are expecting on the call, we might not really be able to unmute people to speak. But if you have questions, you can put it in the chat box. After each of the topics, we will read whatever question we have there and answer it. Well, depending on that time, how we do on time, we may also accept one or two people to ask questions. My name is Abiola Fajimi, and I will be the course lead for the 4 weeks, but I will be joined at various times by my other colleagues, Babatunde, and one or two other people will join you. In terms of experience, I have about 20 years, over 20 years experience in consulting. I've spent all my life in professional services, and I can also tell us that I've done IFRS for the last 16, 17 years. I've been privileged to be implementing the IFRS. So in terms of IFRS work, I'm sure if I count, I've trained more than 350 entities in Nigeria on IFRS. When Nigeria was adopting IFRS, I had privilege to have done more than 100 IFRS projects. Yes, I have considerable experience, but I also always tell you that we learn every day. As a trainer, never you claim to know it all, but I hope that we'll gain one or two things also in the course of the 4 weekends. I'm a chartered accountant and member of the CITN. Babatunde Abimbola will join me, will facilitate this training together, most part of it. Babatunde is also a chartered accountant and is a senior manager with PML Professional Services. Before PML Professional Services, he has worked in Zedo Ososanya Co., WF Orodi and Partner and Co. Just a brief word about us. PML Professional Services is a professional service firm, and our business centers around audit, tax, advisory, and specialized software, which is around accounting software and governance, risk, and compliance solution. Well, as a firm, we've been around for more than 12 years. And one of the things we did in 2012 when we started out was assisting companies to implement IFRS, which we did extensively. So today is day 1, February 2025, 1st of February 2025. And this is the 4 topics we will deal with within the 2 hours. We'll deal with IAS 1, presentation of financial statements. We'll look at IAS 8, accounting policies, changes in accounting estimate and error. We'll look at effect of changes in foreign exchange rates, and we'll look at revenue, IFRS 15, revenue from contract with customers. As much as possible, we want to discuss practical things. We want to focus on what are the things if you are applying this standard on your feed or you've seen a transactions, how do you deal with such transactions? On day 2, which will be next Saturday, we will cover IAS 16, property, plant and equipment, IAS 40, investment properties, IAS 2, inventory, IAS 41, agriculture and biological assets, and IAS 23, borrowing costs. So we'll cover these 5 standards next week. The following week, 15th of February, we will deal with IAS 38, intangible assets, and financial instruments. Financial instrument is one of my best standards. I'll tell you, I'm a financial instrument expert and a financial instrument modeler. I do a lot of financial instrument work and modeling. And if you are a participant in this room this evening and you work in financial services industry, I will tell you, don't meet that section. It will be very valuable to you. And then on 21st of February, which will be day 4, we'll look at provisions, contingent liabilities, and contingent assets. Then we'll look at IAS 10, events after reporting period, IAS 19, employee benefit, and IAS 12, taxation. And that's what we planned out for the 4 weekends. If there is any particular standard that we think is very important, if you get such feedback, we can look at how we will incorporate it. So let's start the ball rolling for today. So in terms of IFRS, I mean, just to put IFRS and its adoption in context for some of us that may not even be familiar with IFRS. So when we talk about IFRS, we are talking about a global accounting standard that is used by several countries in the world. And Nigeria also adopted the standard in year 2012. We adopted IFRS in year 2012. When you hear people saying they adopted IFRS, it means that they've taken in the IFRS 100%, because there are some countries that do not adopt IFRS. Rather, they adapted the IFRS, which means they modified the IFRS to suit their own reporting. So they changed 1 or 2 in IFRS. So it's not 100% IFRS, but it's close to IFRS. But Nigeria as a country adopted IFRS in year 2012. And IFRS as a standard, for those of us, maybe if you have implemented or you've used Nigeria Statement of Accounting Standard those days in the early 2020, I mean 2000 and before the IFRS adoptions, we're using Nigeria Accounting Standard. But one thing with IFRS is the complexity of the requirement. IFRS have some complex requirement, especially if you work in a very complex environment. There is always concern about the consistency of the application. People always have worry that this principle, because IFRS is principle-based, so I will sure that the principle is being adopted the same manner across entities. And then one interesting thing also about IFRS is continuous changes of IFRS. IFRS is always changing. It changes from time to time. And for any user of IFRS, continuous learning is required. You have to continue to learn. Learn and learn and learn and learn. That's what IFRS is all about. I'm sure maybe on the last day, we can also put as part of the last day an highlight of the expected changes in IFRS, because every time there are always pipelines of changes that you expect to happen in IFRS. So we'll discuss that. What are the key changes that we're expecting to happen? Even in the course of this presentation, we'll talk about some of them, but we'll focus on that on the last day. So, what does IFRS, or why IFRS? Really, the basis of it is the fact that as accountants, we run on accounting standards. And, our accounting standard is a set of guidelines that provide a basis for the preparation of financial statement. And as an accountant, you have to comply with it. And I will always say they are just like law to the accountants. In reality, they are just equivalent of laws to accountants. You don't have, or you have no basis of not complying with those requirements. In fact, as accountant, every transactions you are doing, you must ask yourself that question: what is the applicable accounting standard or relevant to this my transaction? So now you are sure that you've dealt with that transaction in line with the requirement. So in 2001, International Accounting Standard Board was formed to serve as a successor to what we call International Accounting Standard Committee. For our fathers in the 80s, in the 90s, we have what we call International Accounting Standard Committees, which then were issuing what we call International Accounting Standard, IAS. But in 2001, that International Accounting Standard Committees was changed to International Accounting Standard Board, which now issues IFRS. So IASB promote the adoption of this standard in all jurisdictions. So when we talk about IFRS, there are 4 things we are always talking about. IFRS itself. So if you look at IFRS, you will see that some standards are IFRS. IFRS 1, IFRS 2, IFRS 3, IFRS 4. The same thing, you will see some IAS, IAS 1, IAS 2, IAS 8, IAS 14, like that. The difference is that the new body, IASB, issues IFRS, whereas IASC, International Accounting Standard Committee, issued IAS then. They were the one that issued IAS, whereas the new IASB is issuing IFRS now. All the standards that were issued by International Accounting Standard Committee is still valid as far as it has not been deleted or replaced. Because one of the things that IASB is doing is also to replace those IAS. So you find out that your IAS 1 to 40, there are some missing ones now. They are missing because they've been replaced by IFRS. So the ones that are issued by IASB is called IFRS. But the two of them, as far as they are still in existence, have the same power and they are equal. They are all part of IFRS. Then we have what we call Ifrs and SIX. A lot of us might not even be familiar with those ones. So these are interpretations. Occasionally, when there are some ambiguity or there is need to clarify certain part of the standard, IASB issues these Ifrs, International Financial Reporting Standard, International Financial Reporting Interpretation Committee issued the interpretation and for the operators to use. The same way the old IASC, International Accounting Standard Committee, used to issue 6 standard interpretation committees, which are the interpretation of the standards. So all of these are what made up IFRS. Now we'll move to IAS, sorry. So now we'll start with IAS 1. And your IAS 1 deals with the presentation of the financial statement, which is essentially is the standard that talks about how you present information in your financial statement. It is applicable to all financial statements that are within the scope of IFRS, even if we are presenting an interim financial report. Interim financial report, meaning financial statement that is not up to 1 year. And it's applicable to all entities. The terminology in this standard is profit-oriented terminology. It's profit-oriented terminology that is used. So it's not a not-for-profit entity language. But sometimes you find out that some not-for-profit entity are adapting it. Now I use the word adapting. They are modifying the content to be able to use it even as a not-for-profit entities. It's also applicable to entity that does not have equity, but they are represented, the equity or the members' interest is represented by unit holders' interest. Example of that is maybe those funds, because your funds, your mutual funds do not have equity, but the interest is represented by members' contribution. So it's applicable. What must you always have in the financial statement? There must be a statement of financial position, which is our old balance sheet. So if you see, I still see that some people are still using the word balance sheet in the financial statement. That's completely wrong. It's statement of financial position. We have statement of profit or loss and other comprehensive income, which is your old statement of profit and loss, the what we used to know as profit and loss account. We have statement of changes in equity, which is a complete new, a unique statement of its own. We have statement of cash flow. We have summary of significant accounting policies, which document the accounting policies that has been used in preparing the financial statement, and any other explanatory information. In terms of every financial statement, the The IAS1 requires that when we want to present financial statement, it should be fairly presented, and it should be in compliance with requirement of IFRS. What does fair presentation mean? Fair presentation means that the fact should be correctly stated. And that is really expected of us as an accountant, that when we are stating the fact in the financial statement, we should state it as it is. So financial statement should be fairly presented, and it should be in compliance with IFRS. And if you look at every financial statement, there's always a statement that states that we have prepared the financial statement in line with IFRS. We prepare financial statement using a going concern assumptions, because immediately you cannot use a going concern assumption, which means that if you think the business will not continue to exist, that means that all your assets will become current assets. But that's not what IAS1 expects you to apply. You are not expected to use IAS1 if you can no longer continue the business on a going concern basis, which means you will end up liquidating the business. And immediately you will conclude that you cannot continue the business on a going concern basis, all your assets becomes current assets. IAS1 expect that we will apply accrual basis. We will recognize the transaction. We recognize an expense when it's incurred, not when it is paid. Immediately you have an obligation for an expense, you've enjoyed an expense, you need to recognize it. You do not wait till you pay. If you wait till you pay, that's cash accounting. The same way when you earn an income, you recognize it, not when you receive it. So that's what IFRS expects us. And that's what will lead us to having receivable or payable. Materiality and aggregation, IFRS also expect that we will group similar transactions together so that they can be reported together. Offsetting, you can only offset transactions that are permitted or allowed by IFRS. If the transactions are not permitted or allowed by IFRS, you cannot offset or net it off. Or if it is not allowed legally, you cannot offset it. I'll give you a good example. You have a customer that owes you money, so it's a receivable in your book, and you also owe him money. It's a payable in your book too. Should we net it off? The only condition you'll be able to net it off if the agreement is that contractually we are going to be settling it net. So your obligation is net, not that I'll pay you what I owe you and you pay me what you owe me. If it's that way, that we'll pay ourselves separately what I owe you and you pay me what you owe me, then you cannot report it net. You cannot offset. IAS1 also expected that financial statement will be prepared every 12 months. Comparable information, you are expected to state comparable information in the financial statement. So for every financial statement, there must be a second, at least 2 columns, except if you are a startup. So it's your first year of operation, then you can present only 1 column. Outside that, you need to always present 2 columns in the financial statement. Consistency of presentation, we're expected to present information year on year the same way. Some people, you see what they do, by the time they are doing another year financial statement, they will just go and change the comparative numbers to say we are aligning it with the new year presentation. You can do it, not that you cannot do it, but the standard requires that if you do that, you need to disclose in the financial statement that you have restated some of your comparative numbers, and you will explain why you have to do that. So we must be careful in changing our comparative numbers. Even the tax authority don't take it easy now when they find out that you are changing your comparative numbers. They want to see what you presented last year, the following year. Your financial statement must always be structured. And part of the structure is the name of the financial statement must be clearly identified. The name of the financial statement must be clearly identified. And then the statement of financial position must be there. The statement of profit or loss and other comprehensive income must follow. The statement note plus other disclosure. It is important that the financial statement is organized. When you come to the statement of financial position, you will see the note. Putting the note reference, the note must follow that same chronological order in a well-arranged manner. it must follow from beginning to the end, and it must be consistent. The same thing for your statement of profit or loss and other comprehensive income. It must be arranged in a very logical order. Let's look at some of the information we need require for the statement of financial position. And information to be presented in your statement of financial position are things like you will disclose your property, plant, and equipment if you have it, investment property, intangible, financial asset, investment accounted for using the equity method, biological asset, trade and other receivable, cash and cash equivalent. All of these are various line items that you can disclose in your statement of financial position. And when disclosing them, you need to be conscious of the materiality, because if you can group some numbers together, group them together, it is better than, I mean, if they are similar, they have similar attributes, you can group them together. So if you look at this, you can decide on, okay, these are the line items that I need to have in my statement of financial position. And then you can present it in current and non-current style. And if I may ask, let me ask. I know I'm about to go beyond my time, but let me ask us. Let me see. Yes. So when do we present current and non-current style? When do you use current and non-current style in presentation of your financial statement? Can I have answers in the chat box? When do you use current and non-current style to present your financial statements? I want responses. Can we try? Chat room. Yes, class. I don't have any response from anybody yet. When do you use current and non-current? Okay, Ayomide raised hand. Okay, Ayomide. Let me see if I can just locate you. Ayomide. Ayomide, you can unmute. Ayomide, you can unmute. Okay, let me unmute Bakari.
Okay, good evening, everyone.
Bakari, Bilkis. Yes, please,
Yeah,
go ahead.
evening, so the current and non-current distinction is applicable when the company is still a going concern.
Okay, then when it's still there, a going concern. Yes, any other trial? I don't know. Okay, let me help us. So we use presentation as current and non-current when the business is largely an asset-driven kind of business, and liquidity is not what is priority for that business. If the operation of that company or entity is largely an asset-driven kind of business, an asset-driven kind of business, and order of liquidity, information about liquidity is not what is important. And I will tell you, by default, the standard expect that companies will be using current and non-current presentation, which means you will show all your non-current assets together, then you show your current assets together. The same way you show your non-current liabilities together, and you also show your current liabilities together. But some industry presentation into whether you can realize it within 12 months or more above 12 months is not what is important. What is important to them is liquidity. Those in kind of industry do not do current and non-current distinction. And they are majorly industries that are liquidity driven. I'll give you an example, bank. What is more important to a bank is liquidity as against your current and non-current. No, the important thing is liquidity. So you find out that a bank does not do current and non-current. Rather, a bank does order of liquidity. And so what is the difference between the two? When you look at company that is presenting current and non-current style, you will see that they have a non-current, they have current, then asset, then they go to non-current liability, current liability. And they are usually presented in order of illiquidity. So the first line will be the most illiquid asset. The least liquid asset is what you see first. Maybe property, plant, and equipment, intangible assets. You see them first before you see cash and cash equivalent down, because you show the least liquid asset first as non-current asset. Whereas in a bank that is doing order of liquidity, you are going to see the most liquid asset first. And that's why you always see cash and cash equivalent in a bank financial statement first, before you see things like loan, in fact, before you see financial asset, treasury bill, bond, loans, and co. So that's why you have those two different distinctions. It's very important. Sometimes you see financial statement, people prepare for fund managers and they are using current and non-current. And some of us used to wonder, is it that they don't understand this basic distinction? So please, let's pay attention to that. I'll move forward from this. And then, again, statement of profit or loss and other comprehensive income, you can present it in two ways. Either you use what we call single statement format or two statement format. When you use two statement format, you will do your statement of profit or loss up to the profit after tax, and you close the account. How do you close the account as an accountant? You double rule it. Immediately you see double rule, it means that it has ended. Then you will start with profit after tax and then put other comprehensive income items. List your other comprehensive income items in the below your profit after tax to now arrive at the total comprehensive income. Whereas some organizations do not do that. They just continue. After profit after tax, they put the other comprehensive income items. Let me throw another question. What kind of items? Can somebody give me an example of other comprehensive income items? Yes, Mohammed.
Thank you very much.
Yes, Mohammed, go ahead.
Disposal of assets or situation whereby there is
I can hear you. Please speak louder.
Hello, good evening. Can you hear me?
No, I need more volume. I can't. Okay, sorry. Yes, it's fine now. I think I can hear you now. Please come again.
All right. I said revaluation of assets.
Yeah, revaluation of assets. You want to give us one more?
And also disposal of assets when there is disposal.
Okay. Well, if disposal, well, in a way, but it's considered as part. All of this is revaluation of assets, because when you dispose it off, you come to that to deal with that revaluation in the other comprehensive income. Another example is fair value changes on equity at fair value to other comprehensive income, equity at OCI, changes in actual value, changes in actual liability as a result of the changes in actual assumptions used in preparing it, foreign currency translation reserve, and then changes in fair value as a result of changes in credit rating of the instrument. I mean, the first four are the common ones you can run. In fact, maybe the first three are the common ones you can run through in this country. So what you also expect to disclose, we expect to disclose the income, revenue, finance sources, your share of profit or loss, the expenses. If you have discontinued operation, that's also have to be stated. Then we have the statement of changes in equity, which shows what has happened in your equity. All your equity-related line, share capital, share premium, reserve, special statutory reserve, contingency reserve, depending on your industry, all of them are grouped together side by side, and you show the movement of what happened from changes in the opening balance of prior period to the profit that was added any other items that was added to it or what was taken out. And also, let me make this, all transactions with the owner of the business in their capacity as the owner of the business is routed through changes in equity. So when you pay shareholders dividend, you will debit equity, retained earning. So it will show in your statement of changes in equity, and then you credit their dividend payable. I get to ask here one funny question. Let me tell you, people then say, okay, so our directors have decided that they want to give card dash to directors, the shareholder, or to, yes, to some of the directors. Like some companies have a policy, every year they change the cars of their directors, non-executive, not executive now. And the question I always ask is, really, is that not transaction with them in their capacity as owners? We can debate it, but I don't want us to do that tonight. But anything is really your owner, you benefit from the business in your capacity as owners of the business, supposed to go through equity. I know that people don't implement that to the latter, but that's really the requirement of the standard. Please let me move a bit fast. Disclosure of accounting policy, we expect to disclose accounting policies that was used in preparing the financial statement. And this last point, any judgment that is made by management when applying the accounting policies needs to be disclosed, especially in respect of for your estimates. If there are some estimates, you've made some judgment, you need to disclose it in the financial statements. And the sources of the estimation or certainty, if there are some estimates you've made, you are supposed to disclose what is really is the uncertainty in that estimation. For example, if you do actual liability estimation, you know that there could be a couple of assumptions you made, you need to disclose it. The same thing with fair value financial instrument, you need to disclose those assumptions. Information about your capital should also be disclosed in the financial statement so that people can evaluate the objective policies and process for managing your capitals. Other disclosures, if you propose dividend, you need to disclose it. Remember, proposed dividend is not debited into your statement of changes in equity yet until it is declared and approved at the annual general meeting. Because based on Nigerian law, only the annual general meeting can declare dividend. So whatever is the recommendation of the directors, it is a proposed dividend until when you get to that annual general meeting, when it will be approved. And it's at that point that you can debit the equity and credit liability. Just to wrap up on this, the reality is also that IAS 1 is about to be replaced by IFRS 18. IFRS 18 will now be the new standard effective from 1st January 2027. So I'm sure if by the time we run this course next year, we will be looking at IFRS 18 because we'll just be 12 months away from it being effective. IFRS 18 now has some specific requirements on how the financial statement should be presented and the disclosure that should be made. Let me see. So that's that. Let me see if there is any question while I wait for Babatunde to get ready. I will stop sharing while I quickly look at any question you might have here. As much as possible, please let's use the chat box because we don't have so much time to take all the voice call. Babatunde. Babatunde. Babatunde, you have the floor, please. Okay, I'll make you just in a few minutes, please, Babatunde. Um, okay, so I've made you the host, so you can go ahead.
So, good evening, everyone. My name is Babatunde Abimbola, and I'm here to present IAS 8 accounting policies, changes in accounting estimates, and error. I would like to know if everyone can hear my voice. Please, you can indicate if you can hear my voice. The chat box.
They can hear you.
All right, great. So, and you can see my screen as well.
Yes, yes.
Yeah,
Yes.
so let's continue. So IAS 8, which is a accounting policies, changes in accounting estimates and error. So this standard, the objective of the standard is to deal with how to choose accounting policies. So what are the accounting policies that a company needs to choose for their transactions? That needs to be, this standard deal with that. Also, you look at the reporting changes in accounting policies. So when there are changes in accounting policies that have been previously being used by the organizations or entities, so this standard also look into that. So what are the things or what is expected to be done in such scenarios? So the third one is reporting changes in estimates. So the standard also look at that. When there are changes, when you made a change in your estimates, especially when it comes to prior year reporting, that is in prior year, you are making a changes in accounting policy now, or you are changing in accounting estimates, or you are correcting an error. So that is what the standard is looking at. Majorly, the key thing here is comparability, so that it is easier for the users of the account to understand how the financial information are being reported. So in the selection and application of accounting policies, what are we looking at? IFRS standard and interpretations deal with this. And when we talk of selection and application of accounting policies, every standards, every accounting standards have the accounting policies that are embedded in it. Yeah, so if you as your organization is to report on revenue, then you need to have an accounting policies based on that has been set by the IFRS 15. So what are the presentations that is required of you? What are the disclosures that is expected of you? How is the revenue to be recognized or accounted for? What are the things that you need to look at? So that are the things which have been mentioned in each of the IFRS standards, and in the this will form the basis for you to select and put up your accounting policies. Now, in the putting up your accounting policies, we also need to consider that other IFRS with similar. So if there is no specific IFRS that applies to the transaction that you are treating, that is, there is no IFRS standard that talks around that, what is expected of the organization. So here, other IFRS with similar situations and issues has to be considered, or you look into the conceptual framework basics and pick up, use it as a guide in coming up with the standard accounting policies to be applied for that transactions in your financial statements. Or you also look at the pronouncements and other standard setters and industry practice to come up with your accounting policies. So in coming up in selection and application of accounting policies, the use of judgment is necessary. So use judgment and develop a policy that results in relevant and reliable information. So when we talk of changes in accounting policy, because this standard deals mainly on 3 things. So which are the accounting, when you have a change in accounting policies, when there's a change in when there is a correction of errors, and when there is a change or accounting for or change in estimates. So that is those are the basic things that this IS 8 deals with. So what do we mean by changes in accounting policies? So what is accounting policies? It is their specific principles, basis, conventions, rules, practice that are applied by an entity in preparing and presenting financial statements. So those are what we refer to as accounting policies. When you pull together the principles, basis, convention, rules, practice that are necessary in the preparation and presentation of the financial statements for an entity. That is what we mean by accounting policies. And what are the source of change in accounting policy? So when you need to change your accounting policies, what are the source? So is it that is required by new or revised IFRS, most common? So when there's when the standards require that a new or revised standard has been put in place, then that's a source of changes in accounting policy, or voluntary change into reliable and more relevant information. So maybe in practice, you've been using specific rules or principles in your presentation and preparation of a transaction in the financial statement. But now you feel like there is a more reliable and more relevant information, standard that you can use, policies that you can use, then that is a voluntary change. So these are what could result in changes in accounting policies. If the change due to difference in, so what are the things that will make you to change your accounting policies? Different economic conditions, new events or conditions, previously immaterial effects. So this could result in changes in accounting policy, but then not a change in accounting policy. So what are the things that will make you not to change your accounting policy? So we need to changes in accounting policy. So is the change in policy due to initial application of IFRS? So in your when you change accounting policy, what are the decisions that you need to make as an entity? So is that change in policy due to initial application of IFRS and IFRS? If yes, then does the IFRS indicate a specific transitional accounting method? Yes, if it's also yes, then you have to apply the specific transitional provisions. But where this IFRS your answer to this question is no, then apply the change in accounting policy retrospectively. So it's expected, according to IAS 8, that when there is a change in accounting policy, the change has to be done retrospectively. And when we say retrospectively, that means you need to restate the prior year comparative of the financial statement. So, but if the first question, which is the change in policy due to the initial application of an IFRS, is no, then it could be that this is a voluntary change, and you need to apply the change of accounting policy retrospectively. So, what this talks to is that when you need to change your accounting policy, you need to consider whether it's a new standard that is just coming up, or and in that case, you don't necessarily need to you don't need to apply such retrospectively. But where you are changing voluntarily, or you need to apply the standard retrospectively. So for all changes in accounting policy, you are expected, when there is a change in accounting policy, you are expected to disclose in the financial statement the nature of the change. So the nature of the change has to be disclosed, the amount of adjustment to the financial statement item, the earnings per share, and to prior period needs to be adjusted in the financial statement. If judged impracticable, if you cannot do this impractical, then you have to apply retrospectively, explain why and how to apply. So where it is impracticable to apply retrospectively, it is expected that you need to explain why this cannot be possible in the financial statement. Another thing we need to look at and to disclose is if on application of new or revised IFRS, also report names of IFRS that transitional provision are applied and the likely future effects. Also disclose about the new IFRS release, but not yet effective. So all this needs to be considered in your disclosure. So now let's talk about changes in accounting estimates. What do we mean by change? I mean, estimates, change in accounting. So adjustment to carrying amount of an asset or liability, or amount of asset consumed in period resulting from its present state and the expected future benefit obligation associated with it. So that estimates are judgments in nature. And when we talk of estimates, we are talking of when, for example, the company is using what's it called? Let's say, for example, property, plant, and equipment. You have a depreciation policy, and one of the depreciation policy is that you are expected to use what's it called, the major one, the major accounting, I mean the major policy that is being you can apply on the rates, and such rates could be maybe 5 years for motor vehicle, that you are going to be depreciating your motor vehicle, for example. So on a straight line basis. So, but where there is now need that you are changing, you are still applying that same principle, but the 5 years has now turned to, instead of using 5 years, the company now said, okay, we are not using 5 years anymore. We want to start using 7 years, which is just the depreciation rate that is being changed. Then that is an estimate. You consider that and treat it as change in accounting estimates. But where you need to move from one the policies, accounting policy in your depreciation, That is, you are changing from maybe straight line method to another method of depreciating your motor vehicle, then that is no longer an estimate. That is change in accounting policy. And what is expected of IAS 8, which we will look at later, we'll look into, is what is expected to use. But when there is a change in accounting estimates, what do? You apply it, I mean, prospectively. So you don't restate, you don't necessarily need to restate the your figures in the prior period. You continue from there and you move on. So results from new information on the, so what could lead to you changing your accounting estimate? So when there's the result from new information or new development comes into place. So as I mentioned earlier, your depreciation rate is is 5 years, 5 years, and you later discover that no, because of the Nigerian factor or any other factor, you using 5 years is not really the real estimate. You can use the motor vehicle more than 5 years, and many of the time it has been tested that you use it for like 7 years before the motor vehicle lifespan needs to be changed. I mean, you need to change the motor vehicle. Then it's an estimate. So where you have depreciated it up to the motor vehicle, that's where you continue from, and you move forward from there to 7 years. So that is change in accounting estimates. Estimates are fundamental to the accounting process. So you move forward, and changes are expected and are recurring. So it's expected that you may need to take a decision on changing some fundamental accounting processes, or you have new information about it. So it's expected that things like that will happen, and you apply change in accounting estimates. When there is change in accounting estimates, as I mentioned earlier, you account for it prospectively. So you don't reinstate your figures, I mean your prior year comparative figures. You continue from there and you apply the changes prospectively. What are expected of an entity to disclose when there is change in accounting estimates? You are expected to disclose the nature of the change, and you're also expected to disclose the amount of the change unless effect of future period impracticable to estimate. So where you can where you can estimate for the future period impact, it is expected that, excuse me, to mention or disclose the amount of the change in the financial statements. So where the correction of errors now. So as I said earlier, IAS 8 deals with 3 major things, which are changes in accounting policies. So when you need to change your accounting policy, or when there is a change in estimates, means correction of estimates, or accounting for changes in estimates, and when there is when you need to account for correction of errors, or especially prior period errors. So how do you? So these are the major 3 things, that 3 major highlights of IAS 8. So what do we mean by prior period error? An omission or misstatement in previously reported financial statements from failing to use or misuse of reliable information. So that is an omission, and it has to be reported retrospectively. So for example, in prior year, you have misstated, or you are not aware that an invoice has not been captured, which relate to prior year, and the information is just getting to your knowledge in the current year. And the financial statement of the prior year has been prepared and dusted. Then you are now in this current year, and you just got to know that this amount, the invoice is not captured. So you need to look at materiality. So IS 8 also talks around materiality. So it's not everything errors. Errors that needs to be applied retrospectively. So you need to look at the materiality of that error before you can apply the error retrospectively. So if the amount of the invoice, sales invoice that we are looking at is very material, when you consider the figures, when you consider your revenue amount that was disclosed in prior year, then such error needs to be restated in the prior period comparative, and there should be disclosure to that effect. So that is, for example, arithmetic mistakes, which are material, mistake in applying accounting policies. So misrepresentation, the one that I just talked about, can be seen as misrepresentation. It could be a big arithmetic mistakes, material mistake that has been made in prior year, and the information is just being noticed in the current year. Or it could be a mistake in applying accounting policy. So those could lead to error, material error in the information that has been presented in the prior year financials. So in that case, you need to apply the standard, IS 8, and change in accounting error retrospectively. So accounting for correction of error, when you need to correct an error that are material in nature, then, as I said, it has to be retrospective restatement of that prior period figures. As if you need to also look at it as if the error has never been made. So that is, you will apply it, you will change the financial information of prior year as if that error has not been made. And if impracticable to determine period-specific adjustments, use partial retrospective application, or even prospective treatment. See changes in accounting policy, so which have been mentioned here. So where it is impracticable for you to determine that the error, the period, the error you want to adjust is you cannot really put figure to it, then you need to move forward and treat it prospectively. What are the disclosures that's expected when you are correcting prior period error? So the nature of the error needs to be disclosed. Amount of corrections for each financial statement item, earnings per share, and to prior period needs to be disclosed. If judged impracticable to apply retrospectively, you need to explain why, how apply and date from which error is corrected. So those are the disclosures that is expected of a user of the financial statement. So I would like to know if we have questions on this, on IS 8. So I would like to know if you have questions. You can indicate if you have questions in the chat box, or if possible. Hello, can we hear me? if you have question on IS 8, you can let us know.
Okay, I think I should. I mean, there have been one or two questions, and I've tried to answer that. So let me read the question. There's one question from Mohammed Obashola, and he said, um, a change in accounting estimate for instance in depreciation method from using reducing balance method instead of straight line after 2 years, will this be done retrospectively or prospectively?
Okay, thank you. So that will be applied retrospectively. So because you are changing, that's accounting policy. So it's not an estimate. So you are changing the accounting policy on how you are depreciating your assets. So it has to be dealt with retrospectively.
Well, I mean, different view because depreciation is a very unique one in terms of really interpreting the standard.
Okay.
That's what, but because depreciation is an estimate, depreciation is an estimate. So it's really considered that anything that changes your depreciation amount is a change of your estimates. But like this thing is now, let's say, what thing is revaluation of property, for example, which is not an estimate. If you are changing it, it's a complete from cost to, if you are changing the basis of measurement from cost to revaluation model, that is a complete change of is a change of accounting policy, is retrospective. But for depreciation is an estimate, and once it's an estimate, it is applied prospectively. The same issue is with tax, for example. Even when your tax figure is wrong in prior year, if your tax estimation is wrong that you put in their account, when you are doing it this year, you will not go back and change last year. Not because it's not a change, but because it's an estimate, and you don't change an estimate retrospectively. It's always prospectively.
Yeah. So I understand your concern. But what the standard is talking about here, depreciation here, I understand that depreciation is a change in estimates.
Yes.
But when you are changing policy, accounting policy.
So the issue, because it's an estimate ab initio, so we will have to apply it prospectively. You understand? We'll apply it prospectively. So that I can be sure that we've dealt with Mohammed.
Okay, let's move forward.
Yes.
So someone also asked a question for assets. Sorry, I can't see.
Let me read this next one. He said, that's from Christian. If a company does not have an accounting policy, I am to audit revenue, do I find them wanting based on the application of the standard? I am to audit revenue, do I find them wanting based on the application of the standard? I'm not sure, but my guess is that he's saying that if a company does not have accounting policy and is to audit the revenue, do I find them accounting policy? Which I think, okay. I mean, yes, go ahead.
Continue, sir.
No, go ahead.
All right. So for every transaction or to be disclosed in the financial statements, there must be a policy that has to be. So if the company has a revenue, if they have revenue, so it's expected that there will be basis, there will be standard, which is IFRS 15, that needs to be applied. So that will form the basis for coming up with the accounting policy as the auditor for the organization.
Okay. Let me see if I can unmute Christian. I can ask him to unmute so we can. Oh, sorry. You are the one. Maybe you transfer the hosting right to me.
Okay, sir.
The host right. Um, I don't have I see Mohammed Obashola. Please, I see your response, and it'd be nice. Do your research, and let's talk about it at the next class. Do your research. I will give you opportunity to share your thoughts next class, next weekend. Next, if the accounting policy is changed without substance form, is it a change the policy of an estimate? Accounting policy. Okay. I encourage people to study on this accounting, to change in account depreciation case study. We can talk about it at the next event so that we don't use the whole time to debate this. Okay, so let's move to IFRS 15 revenue from contract with customer. This started this with income revenue recognition, and revenue is income that arises in ordinary course of activity of an entity, and it is referred to by a variety of different names, including sales, fees, interest, dividend, and royalty. Anything that has to do with sales, fees, interest, dividend, and royalty is considered as revenue. And so the standard explain when should we recognize the income in the income statement. When should we recognize the revenue? Revenue is recognized when it is probable. Just a moment, please. Revenue is recognized when it is probable that future economic benefit will flow to the entity, when you expect that benefit to flow to you, that's when you recognize revenue. So you can say whatever is the benefit of this, we will enjoy it. And the future economic benefit will flow to the entity. And you can measure it. You can determine how much it is precisely. You recognize it. Scope of IFRS 15 applies to sales of goods, when you are selling goods, when you are rendering services, or used by order of assets yielding interest, royalties, and dividend. Any asset that yields interest, royalty, and dividend. Revenue then arising from construction contract. So construction contract is also part of this. Is IAS 11 is no longer in operation. So construction contract is part of it now. It is not applicable to revenue from hire purchase. Revenue from hire purchase is dealt with under IFRS 9. It's not applicable to insurance contract, and it's not applicable to change in fair value of financial asset and financial liability or their disposal. In recognizing revenue, the standard requires us to use the 5-step model. 5 things we are supposed to determine to be able to determine whether we have revenue or not. Number 1, we need to identify the contracts. For you to have revenue, you must have a contract. There must be an agreement to perform. There must be an agreement between 2 parties that creates a right and obligation. 2 parties must have agreed on something that they will do it. It doesn't necessarily have to be written, but once there is that agreement, you have an obligation, and you must have approved the contract. Payment terms, how you be paid, must also be clearly identified. The contract must have commercial substance. There must be a commercial substance for that contract. It is probable that the entity will pay, and the entity is likely to pay. Number 2 is that you must determine the separate performance obligation within the contract. What are you expected to do in that contract? What is your obligation in respect of that contract? And that must be clearly identified. Some contracts, for example, may contain more than one obligation. They must have several obligations embedded in that one single contract. I will give you an example. If you enter a contract to buy or to sell a car, and you decide that, okay, when you buy this brand new car from me, I will give you 1 year free servicing and maintenance. You can see that when the customer buys that, he has bought 2 things from you. He has bought a car, and he has bought free servicing and maintenance contract from you. So which means in that one single contract, you have 2 obligations. You have 2 separate performance obligations, and you need to treat them separately and recognize them separately. So that must be clearly identified in the contract. The next one is that you must determine the transaction price. IFRS 15 defines transaction price as the amount of consideration the entity expects in exchange for satisfying a performance obligation. How much consideration are you expected to get to satisfy your performance obligation? For this contract of buying a car, how much are they supposed to pay me? 10 million naira is what they're supposed to pay me. And that 10 million naira is going to cover the 2 performance obligations. The car and the after purchase servicing is going to cover the 2 obligations. You must consider the variable consideration. Some contracts have variable consideration. Like they will tell you, okay, if you don't report any damage, you will return so amount back to you. Or if you meet certain number, we will adjust the price. These are variable consideration, and we need to consider it in determining the price of that actual transaction. When the contract has significant financing component, we also need to consider this financing component. E.g., buy now, I'll pay later. If you have money to buy the plot of land, we'll sell it to you 5 million. If you want to pay over a period of 12 months, you will pay 7 million. That 7 million technically is the financing element of that transaction. Which means when you want to recognize it, you need to recognize the two performance obligations, because if you buy that land now and you have your money, you pay 5 million. Because you don't have money, you pay 7 million. So I must recognize the two obligations. 5 million is for the land, 2 million is for financing components. The two has to be recognized. For non-cash consideration, when you have a transaction that you are not paying cash, you also need to consider that. You need to determine the transaction price, which is going to be the fair value of that transaction if ordinarily you wanted to pay cash. So if somebody has dashed you a car, or you've given out the cash and you want to, you've given out a car and you want to recognize the revenue, because it's a donation, you may not know. So you can easily say, okay, if I assume I wanted to sell, maybe you gave out the company's official car, old official car, so at free. So how much will you recognize as revenue? What you can do is to consider, if you have ordinarily asked somebody to come and buy it, how much will you have bought the car? Consideration payable to a customer. We will also consider how much really are we going to pay to the customer. Then the transaction price will need to be allocated to each performance obligation. You need to allocate it to each of the obligations so that you can account for it separately. E.g., if you, like the case of land I've just mentioned, you must be able to separate the 7 million to say 2 million is for the land. 5 million is for the land, 2 million is for finance costs. That obligation, the consideration must be separated. The price must be separated apart. The same way, if you buy a car and you have after service for 1 year, you need to determine, of the 10 million naira you purchased the car, how much is for after service. The amount that is for after service may be 1 million. And how do you determine that? You ask yourself, if you want to have a customer that will be coming to your service center to maintain their car for a 1 year period, how much are you going to pay? Or if you have a customer that will buy the car and he will not come for after service, is he going to pay an amount different from 10 million? That is going to help us to be able to determine what is the cost of the after service. So the standard requires that we will separate the two. Then the third point, the fifth point, is when you recognize revenue. You recognize revenue when you have satisfied the performance obligation by transferring a promised goods or services to a customer. Immediately you meet that performance obligation, you need to recognize the revenue. So you must determine your performance obligation, which is the second step. So if, like the case of the car, for example, immediately you sell the car, because you've determined that the after sales service will cost 1 million. Immediately you sell the car, you need to take the 9 million naira in as your revenue, because you have sold the car to the customer. That is already revenue. The remaining 1 million that represents your after sales service needs to be recognized differently, because your performance obligation is different from that of the obligation of selling the car. The same thing, the land that I've given as an example. So the last one said, if IFRS state that when I satisfy a performance obligation over time, if one of the following conditions is met, the customer simultaneously receive and consume the benefit provided by the entity as the entity performs. So for some obligations, they need to be satisfied over a period of time, in which case, as the customer is enjoying the obligation, you need to be recognizing the revenue. Example, the after sales point that I've just mentioned. Because if you promise the man for 1 year, the customer 1 year service free, it means that as he's coming in gradually, is utilizing the benefit over the period of 1 year. The same way that 1 million naira, you will need to be recognizing it gradually over a period of that 1 year, because your obligation will be performed over a period of time. Another good example is if you place instrument with a bank, for example, and they are going to give you interest, you cannot recognize the total income you will get immediately. You need to recognize it over a period, because that obligations will be performed by the bank over a period of time. Your assets they are utilizing, they are going to utilize it over a period of time. So on a daily basis or weekly or monthly, you will be recognizing the interest income as income, because it's a performance obligation that will be performed over a period of time. This is very important when recognizing revenue, and sometimes it causes arguments, even with other professionals. We must be able to ask ourselves, what is the obligation? Are we performing it over a period of time, or it is one-off? The entity performance create or enhance an asset that customer control identity is created. If it's also such that as this obligation is performed, your services is creating or enhancing an asset gradually, that means that your revenue would need to be recognized over a period of time. E.g., construction, they've given you the money for constructing the building, you cannot recognize revenue even while you have been given money. You need to recognize your own portion of the revenue, maybe your professional fee, as you build that building, because your obligation is to build the building, and so as you perform it, you will recognize the revenue. The entity performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed. Once you have a right that after you've performed that obligation over a period of time, you will have to be settled, you can also recognize revenue. If performance obligation is satisfied over time, then revenue is recognized over time based on the progress towards the satisfaction of the performance obligation. The same way, if, for example, you lease your asset to somebody, obligation will be performed over a period of time, so it needs to be recognized as revenue over a period of time. For sales of goods, one of the major important things is significant transfer of significant risk and reward of ownership. You must be able to demonstrate that you've transferred the risk and reward of ownership to a third party. I'll give you a good example. You've sold a car to somebody, but he has not come to pick it up. The question will be, have you made a sales or not? He has paid. The only way to be able to determine that is to look at the risk and reward of ownership if it has been transferred in that goods. If the risk and reward of ownership has not been transferred, then you cannot recognize revenue. So if by the contract, the agreement is that you will deliver the car to my house. So if you don't deliver it to my house, you have not completed your sales process, then you cannot recognize revenue. Or maybe you even have an agreement that as far as the car is still in your warehouse, if anything happens, the company still bears it, meaning that they still have the risk and reward retained, then revenue cannot be recognized. This is very important, because if you are involved, take for example a Dangote, for example, I'm sure they will always have issues of revenue cut off, because on 31st of December, they might have goods that are still on their way to the customer. I'm not sure, but I can guess that until the cement is delivered to the customer, the risk and reward has not been transferred. If anything happened to the trailer on the road, they will need to give the customer another cement, which means the risk and reward still remains with the company until the goods is delivered to the customer. And I will expect that maybe on 31st of December, they will have some items on the road that have not been delivered to the customer, but it has left maybe the warehouse. Such item, for example, they may not be able to recognize it as revenue because they have not handed it over to the customer yet. The risk and reward has not been transferred to the customer. We need to also be careful when we are looking at sales that has to do with installation and inspection. For example, you have sold an AC, but the agreement is that you will sell and install. Are we going to recognize sales even when we've not installed? Just because we have moved it to the factory, I mean to the office location, are we going to say we have made a sale or not? It can be tricky, and it depends on how the wordings of the contract is. And this is where accountants add value to legal documents. I can word it such that the sales of the AC is different from the installation. So, and I will tell you, immediately I deliver the AC in your compound or your complex, I consider it sold, I will come back and install it. Two different services, two different performance obligations. You can structure your contract that way, in which case you can recognize sales for the delivery depending when you install, and you now also recognize maybe another fee for the installation. Sales on approval. Some sales, again, even while you have issued an invoice to you for it, we cannot consummate the sale until we get an ultimate final approval. Sales in such case is also not considered as a sales because the necessary approval has not been obtained. Warranty, if you have business that have warranty, that is an assurance that, okay, if anything happens, part of it, maybe you'll be fixed or you'll be refunded or they will compensate you. You need to look at what is the cost of this warranty, and you may need to separate it from the sales value, because in pricing that goods, you will have factored in the element of that warranty into the price. The same thing for consignment sales. If you are selling an item to another country, you need to be sure at what point does the risk and reward transfer. Is it at the point when you load the item to the container, or at the point when the item is delivered, or at the point when the consignment laid? So we need to be sure all of this will affect your revenue recognition. When it comes to rendering of services, which can be measured reliably, revenue associated with transaction shall be recognized by reference to the stage of completion of the transaction at the end of the reporting period. We'll look at, for rendering of services, is usually performed over a period of time. Just like if you are doing an audit, if you are doing professional services, you are performing that activities over a period of time. So you need to recognize revenue based on stage of completion. How much have we done at that point? So we must look at installation. I've spoken about installation, advertising and insurance agency. If you run an advertising and insurance agency, let's look at insurance. If you are a stockbroker, at what point do you recognize commission? When you collect the money or when you transfer it to the insurance company? So depending on the agreement you have, which most time is once the money is in insurance brokers, and really he has performed his obligation, which is to collect it from the agent. Okay, to also transfer to the insurance company. Maybe immediately he transfers it, the commission is earned. We might need to look at their contract again. I've not reviewed their contract in a long while. Admission fee. Let's talk about admission and tuition fee. You just got admission to a university, or you are a bursar of a university. At the point of entering university, student pays admission fee. And the same way they pay tuition fee. Admission fee typically is the obligation, the reason the performance obligation why the school collect it is for giving you the admission. And they will tell you immediately, we've given you the admission and you pay that admission fee, we have performed our obligation in respect to that admission process because we've given you an admission letter. That's why you have paid. Whereas tuition fee, you will hear, okay, tuition fee is for a whole year. For the lectures you are told to take for 12-month period, that's what the tuition fee is for. So the performance obligation is for over a period of time. Entry and membership fee into maybe professional association or any association, again, at entrance point is usually for joining. The obligation is for accepting you as a member. Immediately they accept you and you pay the entrance fee, the association has fulfilled its obligation. Whereas membership fee can be for an obligation they owe you for the 12-month or 36-month of your membership, which means this should be recognized over a period of time. For interest income, interest is recognized using the effective interest method as set out in IFRS 15, and it's also over the period of using that instrument, being utilized or enjoyed. So period when you are giving loan out, or period when you have invested in a bond. That's the period you recognize the revenue from that interest. Royalty is on an accrual basis according with the substance of the relevant agreement. Royalty again may not be that straightforward because depending on the contract, like some royalty is based on time. They say as far as you are there, you are paying us this royalty for 1 year. Some is the royalty will be based on the quantity of the item you extracted from the ground. So as you bring it out, your royalty is calculated. So depending on that will also determine the basis of recognizing royalty. Dividend is to be recognized when the shareholder's right to receive payment is established. I've mentioned that. And I saw that somebody asked question around interim dividend and final dividend. When it comes to interim dividend, it means that it was paid during the year. It must have been approved in between the year, in which case you will have been able to debit it to your equity because it's no longer proposed at year end. So your dividend, your interim dividend, it will have been declared at the annual general meeting before the year ended. In that case, you have debited it to statement of changes in equity, whereas the final dividend will be a proposed dividend at year end, and you'll be expected to get it approved at the annual general meeting. That's the difference between the two. So for your interim dividend, it usually have been declared and approved at the annual general meeting. So you will not treat that one as proposed. But for final dividend, it will still remain proposed until you get to the annual general meeting after the financial statement has been prepared. You are to disclose the accounting policy that you've adopted for the revenue, the method you use to determine the stages of completion, and the amount of each income categories of revenue. Each of the revenue category has to be disclosed in the financial statement. And any revenue that is arising from exchange of goods or services included in each income category of revenue must also be disclosed. Before we take the last one, let me see if we have any question in the chat box. We have 15 questions. Okay. Thank you. I think Babatunde has responded to all of these questions. Thank you for that. Okay, let's go to the last slide. I'll just take the last slide and then we'll take any other question. Let's look at IAS 21, the effect of changes in foreign exchange reserve. This look at exchange rate. How does changes in exchange rate affect your financial statement? One is financial statement are sensitive to changes in foreign exchange rate. Financial statement numbers changes as the exchange rate changes. And your foreign exchange rate can have your foreign exchange rate exposure can be in 3 different forms. One, foreign transactions. If you buy or sell in other countries, if you buy dollar or you sell in dollars, you buy or sell in other foreign currencies, then you have foreign transactions. You buy or sell an item in foreign currency, another foreign currency, in a currency that is different from Naira or your local currency, you have foreign transactions. Foreign operation, when you operate in business in another country, if you have your business in Ghana, you have business in Benin, you have a business in UK, you have a foreign operation. Then there is foreign presentation currency. That is the currency you present your financial statement. This is very important because sometimes, like some days ago, somebody was here asking me, they don't really do transaction in Naira because they are not and gas. So they do transaction in dollar and asking that, so in what currency are they going to present a financial statement? Because their current financial statement is mainly in dollar. That's where presentation currency comes into play. That's the currency you present your financial statement. So let's go to transaction, foreign currency transaction. When you enter into transaction denominated in other currency as part of your normal day-to-day business, that's foreign currency transaction. So I've explained all of this. Let me go. Foreign currency is currency other than your functional currency of the entity, any currency different from Naira. Whereas functional currency is the currency of the primary activity economic environment in which the entity operates. The currency, the main currency you use to do your business is called your functional currency. Just like the story I told you, the guy's main business is done in dollar. Whereas presentation currency is the currency in which you prepare your financial statement, the currency you use to prepare your financial statement, which for us in Nigeria is usually Naira. We present our financial statement in Naira. So when you run into some clients, for example, that have functional currency that is dollar, and they ask the question, so what are we going to do? The typical response we give or way to handle it is they need to convert all their dollar to Naira. So they will present the financial statement in Naira, and they can then put dollar statement, dollar number by the side in another column. So they can also put another column for the dollar currency. So for this standard, for you to present your financial statement in Naira, for example, if your functional currency is dollar, what you need to do is to determine the functional currency for both the parent and any foreign operation. And even if you have a subsidiary that is in Ghana, you need to determine the functional currency. So I'll say, okay, this entity is operating CD. Then I need to translate the item into functional currency. I'll translate all the items to the functional currency and then translate it into the presentation currency. I will not translate it to presentation currency. So in Ghana, in CD, for example, the company is doing economic activities mainly in cedis, but they could have done one or two transactions in dollars too, even while they are doing mainly in cedis. So step 2 requires that all those dollar transactions must be converted to cedis first, and then you now translate that converted balance from cedis to the presentation currency, which could be Naira. Your foreign currency transaction, this is not transaction. You are buying dollar, you purchase an item in dollar, you need to recognize it in the functional currency. So if we are in Nigeria and you bought a transaction or you purchase something in dollar, you need to recognize it in Naira at that point because your functional currency is Naira. That dollar needs to be recognized in Naira. To do that, what you need to do is to determine the correct exchange rate as at the day you did that transaction. So if we pay for an item in my company to acquire an asset in dollar, what we need to do is to say, what is the spot rate? The exchange rate on the day we make that payment. We will use it to convert that dollar to Naira. And that Naira is what we are going to be reporting in our financial statement. So all foreign currency transaction is converted to functional currency using the spot rate as at the date of the transaction. On the date when you did that transaction, this is what you use the exchange rate to convert. Then what will happen? Let's say 2 scenarios I want to paint for us. Number 1, I bought asset, tangible asset, fixed asset, $100, 30th June at exchange rate of 1,000. That means that I bought the asset for 100,000 naira. That is for PPE. The second scenario is that I placed money. I bought a bond at $100 too on the same day at 1,000 naira per dollar. So I pay equivalent to 100,000. At the end of the year, 31st December, the exchange rate is now 110, 1,100. So it has increased by 100 naira. What will I recognize? This is what this is helping us. Remember, when you bought the asset, the fixed asset, you've recognized 100,000. When you invested in the bond, you have recognized 100,000. On 31st December, what are you going to recognize when the exchange rate is now 1,100? This is a principle you will use. For non-monetary items, you will adjust it at year end using the closing rate. You will adjust it at year end using the closing rate. So that $100 that you put in bond, what do you mean by monetary item? Let me explain monetary item. Monetary items are assets that are cash or cash-like in nature. They are assets you can easily turn to money. You can easily turn into cash, and they are highly liquid in nature. So a bond is a good example of monetary item. So when you want to report 31st December, what you are going to be reporting will no longer be 100,000. It will be 100 times 1,100. 100 times 1,100. And that will give you 110,000, which means you have made a gain of 10,000 because of the changes in the exchange rate, because your exchange rate has increased. Whereas if you have for the fixed assets, the amount will still remain the same because it's a non-monetary item and you must continue to keep it at that historical exchange rate. So that is the difference in that one. So for monetary item, whatever has changed is recognized in your income statement as a gain or loss. When you have foreign subsidiary, what you do is that at the end of the year, all the foreign operation balances, you will translate it into your presentation currency. You will change it from cedis to naira. And when you do that, whatever is the gain or loss, you will recognize it in your other comprehensive income. This gain or loss is usually from your non-monetary item. Because if you look at the PPE, okay, before I say that, for foreign operation, all balances are translated using the closing exchange rate. The exchange rate at the end of the year, you need to use it to convert it from cedis to naira. You use it to change all the numbers from cedis to naira. So for your PPE, for example, that you have used a particular rate when you bought it, by the time you are converting it again at the end of the year, the value will be different from what it was in prior year because the exchange rate has changed. When that happens, whatever is the impact, the difference is recognized as part of exchange translation reserve, as in other comprehensive income, like I mentioned earlier. So it's recognized in other comprehensive income. You have to disclose any gain and loss through profit or loss and comprehensive income. And the fact that if the presidential currency is different from functional currency, you also need to state that. When there is a change in functional currency, you also need to mention that. So that's for that, and that's actually for the evening. We need to pause and look at if there is any other questions that we've not addressed. We plan that this meeting will always end. Okay. All right. So thank you very much. I don't know if anybody has any question. If you has any question, you can just raise your hand. Let me take it verbally now. I can unmute you to just okay. Yes, I think this question also on revenue, Babatunde has addressed it. On revenue, somebody that has the deferred income treatment. So if you deferred an income, meaning that it has not been earned, you need to recognize it as liability, as a contract liability. Contract liability, and it will be recognized as you make the performance obligation. That's how it will be treated. Okay, let me ask Ademola. Ademola, please, you can unmute yourself.
Okay, please. Hi, good evening.
Good evening.
Can you hear?
I can hear you.
Okay. Thanks for the presentation from both speakers. Okay, so my question is just to clarify something between a reporting currency and functional currency. Are they the same or they are not?
No. They are not the same in definition, but it can be the same for an organization. And let me explain. Functional currency is the currency you use to do your business, principally do your business. I'm in oil and gas. I buy and sell majorly in dollars.
Okay.
That's the primary economic currency. My presentation currency is the currency I use to present my financial statements. I present it in Naira because government requires that I present it in Naira.
Okay.
There could also be some people, like we as a business, for example, now, our functional currency is Naira. We deal mainly in Naira. And we also present our financial statement in Naira. So our functional currency and presidential currency are the same. But for some people, it's not the same. And usually, it's usually foreign companies that you find out that you are dealing in Naira, in dollar, and you have to present in Naira because you are in Nigeria. In some environment, they don't box you. But in Nigeria, you are boxed to your presentation currency legally, statutorily. So you cannot say you want to present it in dollar. It's not allowed by law. I hope that addresses your question. Okay, any other question? Tineke, please unmute yourself.
Okay, good evening, sir, and thank you for this wonderful presentation. I appreciate it so much. So please, my question has to do with the income. Actually, I don't know how to address it better. There is this exchange rate, right? At the point of collection, revenue recognition, right? After being satisfied all the standard, then the exchange rate as at that day, the package, we can fix it and we capture the prevalent exchange rate as per the day of the transaction. It's been captured, right?
Yes,
so, but at the end of the year, now, and then at that point, we've recognized the exchange gain and so forth at that point. But at the end of the year, in the bank reconciliation now, I don't know, how do you relate that? Is it there's going to be an additional exchange rate? Because, at the end of the day, bank transaction cannot give you each exchange rate. You have to, when you want to reconcile your bank statement at the end of the day. So that difference, is it additional gain or loss? Thank you, sir.
Okay, so thank you. So once you recognize your revenue at the initial point, that is your revenue for that transaction. But because it's in dollars, let's say when we, just like the case I painted, let's say when we recognize revenue, when we did the transaction was $100 at 1,000 naira. That means that our revenue will be 100,000. But because we did not receive our money immediately, we didn't receive the money from the counterparty, so we had a receivable. By the time he's paying us that $100, the exchange rate is no longer 1,000. It's now 1,100. So when you calculate it at that point, it's going to be 110,000. You see, that difference of 10 is your exchange gain, because you need to recognize the transaction based on the prevailing spot rate on the day when you provided that service. But whatever now happened to the amount you eventually get, because there is movement in the exchange rate, that has to be treated as exchange gain or loss. I hope I address your question. Okay. I want to thank every one of you that have taken your time out, to just be part of this. And so I hope it has been worth your time. Can I even have just a quick response? Do you think it's worth your time with a yes or a no? Oh, thank you. You can give us a thumb up. That would be a good idea, or thumb down. So, okay, thank you. So we will continue again next Saturday, 7 o'clock. It's a refresher course. Think about it. I've seen people debating and arguing on depreciation of changes in depreciation. Don't worry. I'll go and do your research. I like class that people that go and do your research very well and come to next Saturday. We'll start with it. Let's have some very good debates on this. I'm used to this depreciation argument and conversation, so I'm looking forward to it. And please, everybody, enjoy the remaining part of your weekend, and we'll see you guys next Saturday at 7 p.m. Please invite your friends. Don't enjoy it alone. Share it with your colleagues. It's free. It doesn't cost anything. So we'll see you again. And my appreciation to also Babatunde. Thank you for that wonderful presentation. Well appreciated. And all the other support team, Jide Motun, that have made this, and Jason, that have made this a very good event this evening. Thank you so much, guys, and have a good evening. Thank you.